Welcome back to the channel. I'm the Zoneo Mindset, and in today's video, I'll be breaking down the Thrift Savings Plan, also known as the TSP, also known as the Government 401k. And just like I said, Government 401k, that means you have to be a federal employee to have this account, or you need to be a military member. So in today's video, this is my actual TSP account, current investments right here. And I'll be breaking down what each investment fund is, why I don't invest into the Lifecycle fund, and why I feel like, in my opinion, it is better to pick your own funds to invest in versus relying on the Lifecycle fund. So these are the different investment strategies that you have in the TSP. So we have Lifecycle Fund, or L Fund for short, individual TSP funds, and mutual fund windows. Lifecycle Fund, to summarize it, is that it's a target date retirement fund where, based on when you're going to retire, the money will automatically shift to more conservative as you get closer to retirement, and I'll explain more of how they do that when we go into the life cycle funds. Individual funds, you have the G, the F, the C, the S, and the I, and you'll realize that those different funds are already in the life cycle fund, but when you're investing in the individual funds, you're not at the mercy of the life cycle and them reallocating funds for you. So if you want to have a little bit more hands-on approach, the mutual fund windows allows you to invest in things that the TSP may not have access to within these 5 funds. So let's just say if you wanted to take your TSP money and invest into some gold or invest into some Bitcoin, you can do that with the mutual fund window, but I wouldn't recommend it, because if you really wanted exposure to that, you could just make your own retirement account via Roth IRA. That's what I would recommend, because to invest into a mutual fund window, there is a lot of fees associated to that, and I personally just don't think it's worth it. Life cycle funds, it gradually shifts your risk to lower risk as you get closer to the target date or retirement date or whatever date that fund that you're investing in. I will click on one of these just to show you an example. So let's just say if you're going to retire in the next 4 years and you pick this L 2030 fund, you're going to realize that the money is going to be very conservative. So I would explain what the G fund is, and the F fund, the C, the S, and I when we go into each fund individually. But the reason why this is very conservative is because it has a lot of G and it doesn't have a lot of C or S or I. So you're going to see here, based on like allocation purposes, if you'll see, as you get closer to that retirement date, it's going to slowly start selling that C and that S and that I. But a lot of people don't know what it's doing. It's doing that, and then it's buying more G. Why do people have this, and why it may be a good strategy for a lot of people? So as you get closer to retirement and you have a lot of money in your account, because let's just say you've been investing for a long time, and when you retire, you want to make sure that you have more of your cash. So in the event of a market downturn, you don't feel the negative effects of a market downturn, because you're mostly invested into the G fund, which we're going to just say for short, G fund is basically cash. So you're just invested into cash. The risk associated to investing into cash is that inflation is going to eat that dollar away. So that is why people switch to more conservative. So let's just switch to a different plan, which wouldn't be as conservative. We're going to go into the 2065. So if you're my age, 25, this will be the fund that you're currently in if you didn't change it. And as you can see, for the 2065, it is very low on the G, very low on the F, and more than 50% is in C, 35 is in I, and about a little less than 13% is in the S fund. And it does the same thing. So over time, it's going to slowly start investing more into the G and the F and sell off the C, the S, and the I fund. Again, if this is something that you want to be more conservative as you get closer to retirement, that's fine. The problem with this is that a lot of people don't start investing until later in their life, and they may not have enough money. So when you are switching out of stocks and going more conservative, this is a good strategy if you have a lot of money in your investment account and you can afford to miss out on market gains. But if you don't have enough money in retirement and they're slowly selling these stocks and buying bonds and making you so conservative, what's going to end up happening is, by the time you get to retirement, you're not going to have nearly enough to retire, and you're actually going to have to work even longer. So that's why I personally do not invest into the life cycle fund, because I rather have more control over my retirement plan. So the first fund I'll be talking about is the G fund, and the G fund, TSP calls it government securities, but this is really the cash fund or your short-term treasury security purchases, where anything that you're investing into this fund is going to be used to buy US debt at a very short-term rate. So less than 3 months usually is considered short-term US government debt. And the reason why, as you look on that life cycle where I showed about the G fund, as you get closer to retirement, the US has never defaulted on its debts. So it's considered a relatively safe investment to be investing into the G fund, because you're always going to get back your money, quote unquote, because the US government does not default on its debts. Compared to stocks, the G fund is considered safe because you can't lose money. But you do lose money due to inflation, but we'll just say that you don't lose money with this one. So 100% US securities, short-term treasuries. That's all I can say to that. I don't invest into G fund. If you rewind back to the video, you'll see I'm not invested into G fund. So the F fund is fixed income. That's what they call it. It has a little bit more risk, quote unquote risk, because long-term US treasuries, even though the US never defaults on its debts, is more risky because we don't know what inflation is going to become. So when you're buying a long-term treasury, I'll take today's example. Right now, the treasury yield for the 10 years is like 4.6 or 4.7, in that range. And that's saying that the market is thinking that inflation over the next 10 years will be around that price point. Now, if inflation runs even hotter, then people are expecting the yield of the bond will go higher because it has to attract buyers. It's a supply and demand thing. As that yield goes up, the value of the bond goes down. I know that sounds very confusing. That's the risk, because if you're purchasing that bond at 4.6% for $100, but it goes up to 5.3%, then that bond will be worth $80. So the value of that bond will be $20 less, but then that person who's purchasing that bond will get a higher yield to justify the risk of the bond falling. It's a supply and demand thing. And also, when it says like credit and securitized, that's like bank corporate debt. So there's more mixture of different bonds that you're investing in. But again, it's mostly government related. Long-term bond is the F, and the G is the short-term bonds. So these are your relatively considered safer investment options. The next fund I'll be talking about is the C fund, and TSP calls it the common stock index. The C fund is really the S&P 500. It tracks the S&P 500, and the S&P 500 is the top 500 US stocks in America. And if you watch any of my previous videos about the ETF video that I made, that is one of the ETFs that I invest in, is the S&P 500. I'm getting even more exposure within my TSP account with the C fund as well. The C fund invests in Nvidia, Apple, Microsoft, Amazon, Google, Broadcom, Meta, Tesla, and Berkshire Hathaway. And Berkshire Hathaway actually is a company that buys different stocks. And if you want to know more about Berkshire Hathaway, I can make a video about Berkshire Hathaway and Warren Buffett and who he is, because he was the founder of the company. He's no longer the CEO now, because he really old. He is what we call the greatest investor of all time. So that's a little bit about Berkshire Hathaway. And if we look at the growth, this is the chart of the C fund growing, and the inflation rate, even though it's saying $100 became $286, when you look at it from the flip side of purchasing power, it did not become $286. It became less, because the $100 in 1988 cannot buy the things that $100 can buy in 2026. As we all have seen with inflation from 2020 to 2026, that is just an example of why it's important to be investing, because if you are investing, you limit your risk to inflation, which inflation is really just a tax, is another form of taxation that the government does to us. But not to get into another topic. The next fund is the S fund, and TSP calls it small cap stock index, and I would say that's what I would call it as well. So S fund, small caps. So these small cap companies are very risky. They're more riskier than investing into the C fund, because these small cap companies, they don't have as much earnings as those major corporations like Apple. The reason why it's good to invest in the small caps is because Apple once was a small company. So now, if you invest into these small caps, you have the chance of finding the next Apple or the next Nvidia, and you can run up that upside while investing into the small caps. So the small caps, when it outperforms by a lot. Also, when the overall market is down, this will go down a lot more because again, it is more riskier. Invest in the S fund at your own risk tolerance. I do invest into the S fund. It's just not as much as I invest into the C fund. Actually, I have more risk into the S fund than my Lifecycle fund has for me. In all reality, I'm actually probably more risk than my counterparts who are investing into the Lifecycle. And these are the different holdings that it's invested in. So Snowflake, Marvell, Roblox, and yes, that is the company, the game company, Roblox. So yeah, so these like small little companies, you may not know all these names. I know one, two, so I know like five of them because I know strategy. So yeah, these are again very small companies. Since they're very small companies and they have a lot of risks, there's more companies in this basket or this fund versus the S&P, because S&P only has 500. Well, this one would probably have closer to like 2,000 different stocks. The next fund we'll be talking about is the I fund, and the I fund is short for international. This fund is going to be investing into anything non-US. So you're having exposure to different stock markets all around the world. You see, like you have when investing in this, you have exposure to Samsung, you have exposure to Taiwan Semiconductors. So they're like a big company to be invested in because these are where Nvidia gets their chips from. But again, not to go too much in depth into different companies, but this is what the iFund is. You're getting exposure to different countries all around. You got Japan is the number one weight portfolio, United Kingdom, Canada, France, and you see like, and even within that 16%, you're investing in 937 companies, United Kingdom. So there's so many different companies that you have exposure to. Like look at it, Kuwait, Egypt. I wouldn't have thought that there's so much different exposure to all these different countries by investing into the iFund. So even though people say, "Oh, I don't want to invest in the iFund, I don't want to invest outside of the US," I think it's good to diversify yourself. Where in the event that something happens to the US dollar, well, if something happens to the US dollar, I think all stocks are going to plummet. Let's just say in the future, if the US is no longer the reserve currency of the world, you have exposure to these other companies or other countries, not companies, countries. Well, I guess technically companies because there's other companies. And also, another benefit to investing into the iFund is that when you're investing into these companies, you're investing in their dollars. If the Japanese currency ends up strengthening against the US dollar, then you're actually going to make better returns than you would have if you was investing in the Japanese companies, but in the US dollar. If you don't understand how currency exchange works, that could be very confusing. So I might have confused a lot of people just now. Here, I want to break down the match, and I always stress to anybody that works for the government, even to my coworkers, I've always said take advantage of the match, and this is why. Just to break down where the 5% match comes from, right? So the 1% automatic contributions, then you get 3% for dollar matching on the first 3% you contribute, and then you get an additional 1% at 50 cents per dollar on the next 2% you contribute. When you put in 5%, they'll give you 5%, right? This is an example of saying for a federal employee starting at 90K with 1% raises and 8% investment return, the match alone grows to approximately 513,000 over 30 years. This is a comparison between a 3% and a 5% contribution. If you're somebody who's like, okay, I'm only going to do the 3%, this is how much money you're leaving or you're going to make after 30 years. But if you're only putting in 5%, this is how much money you have. So you're noticing a huge drop in your retirement because you decided not to contribute 5%. Are you on track based on age or years of service? So they're assuming that the person starts at 23. I actually was fortunate enough to start even earlier. I started at 20 and I have 5 years of service. As you can see, my TSP is a little under this. So I'm close to ahead but I'm on track. Thank you for staying to the end of this video. I know this was a long video, but the TSP is so vast that I like to make sure that I explain everything to the best of my ability. Also, if you enjoyed the content, please make sure you like the video. Liking the video allows for my content to push to more people because then YouTube will recommend it to other people. If there was any point in the video that you felt that I could have explained a little better and you need more clarification, please leave a comment down below and I'll reply to that comment and give you more insight into anything that you're confused about. And also, if you enjoy the content and this is your first time being here, don't forget to subscribe so I can give you more of this content. And again, this is the Zillennial Mindset, and I'm out.